Everyone, this is Rob Roy of LEA Options, and welcome to TradeFinder Live. For those of you that may be joining us for the first time, welcome. I'm going to give you a quick rundown of how the TradeFinder works. First of all, if you've seen any of our videos or recordings, you know we have to do this disclosure/disclaimer, so please take a screenshot of it if it's the first time you've seen it. Read it in detail at your leisure. Couple things the powers that be want us to make you aware of. Number one, we are not registered to give individual investment advice in the United States. And two, because we have a lot of international subscribers, a lot of international viewers, any pricing that we're talking about is assumed to be in US dollars unless noted otherwise. So the rest of that is just as important, but again, please look at it at your leisure. So the process of TradeFinder is we'll go through and take a look at the market. Pretty interesting what's going on in the market right now. We shared a comment over the weekend with our subscribers. It seemed to be pretty prophetic. They're used to what we talked about. I'll share that with you. Then we'll go through and look and see if we've had any case studies that we've closed, which we have for our alert subscribers with LEA Options. And then we'll go through and look at case study considerations that we've identified in past TradeFinder webinars, and then with whatever time's left following looking for this week's TradeFinder trade consideration, we'll take questions. The Q&A at the end usually consists of you giving us your favorite symbol and us looking at what our indicators might say about it. Again, not giving individual investment advice, just simply saying, hey, this is what our indicators show for your favorite symbol. That's it. That's the process. So with that said, let's go ahead and move in and get started. As you can see with the market move today, what I shared with our subscribers over the weekend, and we've got, I would imagine, if everybody showed up that was supposed to, a lot of new viewers, because we talked about the 420 level on YouTube for many months, going all the way back to when this wave 5 started back in June of last year. And then we've had this whole run, and we've been forecasting the 420 level. We hit it spot on back on the 29th of April. And you can see it's been a pretty good point of resistance since. But then on Friday, the market tried to break out. And this is what I've shared with our subscribers is one day doesn't mean anything. There's a lot of head fakes in the market. So one day movement means absolutely nothing. You have to have a second day, a follow through, a confirmation day. And so I said, okay, the market is attempting a breakout, not a confirmed breakout. It was attempting a breakout, and we need to see what happens on Monday to see if we get a follow through. Well, clearly we didn't get a follow through on Monday. We went right back down to the 420 level. Well, today we gapped lower, and there's a lot of reasons for that. I've got a couple really interesting charts that I'm going to share with you that I'm also going to put in the next SPY update. But we've garnered a lot of attention on YouTube with the fact that we called 420 as a major Elliott wave Fibonacci resistance area, forecasted target price, and then difficult to get through. It's a 161.8% extension on a zigzag. Now, it's not unheard of to go to 261.8. It's just far more rare. You get 100% extensions, that's part of the zigzag. And then a further extension to 161.8, that happens fairly often. But to go to 261.8, that's a little bit more difficult. And if you go back and look at our previous recordings, you'll see where I said I really felt that, you know, looking at a potential short position, if we reach 420 without a significant retracement or correction, might make an awful lot of sense. So that's where we sit right now. We still have this gap down here that is yet to be filled. So we'll be looking at that. We also have a test of the major level there at 400, which would represent 4,000 on the SPX. But the question is, now we had this breakdown today with the gap. So it would have been real easy to go ahead and go short on the rally part of the day today if there wasn't that gap. And if you looked at the market, one of the things that we also share with our subscribers, and we pride ourselves at LE Wave Options, EWOtrader.com, on education. And our subscribers are extremely educated. They go through, they've learned, they share their successes with us on things that they've learned from this and that they've incorporated into their own trading, which is one of our goals here. We don't just want to be an alert service forever. That is never the intent. What we're doing, we want to share with people the power of Elliott Wave and our technical analysis system and help people learn to incorporate that to where they can trade successfully on their own. That's our major goal. And a lot of our subscribers are doing extremely well. But one of the rules that I talk to them about quite often is no security in any time frame is very far away from the 10-day moving average. And people have taken that to heart. They listen. So when we opened and then traded down today, you can see with a gap down and trading at the low, we've already created some distance from the 10-day moving average. So to rally from there, I don't think means anything other than we were oversold at that point in time. Short term, but oversold. So now the point I was trying to make is the question becomes, do we fill this gap before we come down to fill that gap? And that's what's tomorrow's trade is going to tell us. But we've got a whole lineup of really good looking trades to the downside if it shows that the market is not going to fill that gap and come lower. But the fact that not only do we have a gap, but we're below the 10-day moving average makes me think that at tomorrow's trade, at some point in time, we come up and tap that 10-day moving average. And that could be a very good entry, barring some sort of a major turnaround, to go through and set up those downside trades. And I've shared with our subscribers because basically, other than the COVID crisis hitting in March of last year, they've never seen a down market. I've been around 25 years doing this. There's nothing more fun. There's nothing more exciting. There's nothing more profitable than trading in a down market if you know what you're doing, because it moves so fast to the downsides and trades generate gains so fast to the downside. So perhaps we're still going to start to move into that. There's certainly been a lot of warning signs. If you've looked at any of the past SPY videos, we've talked about storm clouds brewing on the horizons, which they have. And we've highlighted some of those, but let me go ahead and share with you a few other things. There's only a handful of people. People have heard me joke about this before, that I watch CNBC, but on mute. And then if there's something that comes on that I feel like might be worth listening to, then I'll turn the volume back on. But mainly it's just on so that if any news event happens, spur of the moment, or somebody comes on that I feel is worthy of listening to, then I'll go through and do that. Well, Jeffrey Gunlock is one of those guys that I do listen to. He's a bond guy. Now, he's not a stock guy. He focuses on the bond market. But I've shared with our subscribers numerous times that if you want to be a good equities trader, you need to have at least a working understanding of the bond market. You don't have to be a great bond trader. You don't have to know the intricacies of the bond market, but you should have a fair understanding of how the bond market works. Why? Because there's a lot of money in the bond market. And in general, amongst elite traders, bond traders are viewed as being really smart. And so you pay attention to what's going on there. So when one of the more elite bond traders speaks, you tend to listen. So let me share with you a few things that he talked about just within the last couple of days. Let me move this out of the way so that I can blow this up for you. Move this down to the bottom here. Now, what he's sharing here is this is the percentage of personal income that's made up by the government. Now, there's been a lot of interest in the jobs reports lately, both first-time unemployment filing claims, as well as the actual employment report, private sector jobs being added. And what he's showing here is how far it's exploded to the upside of people that are receiving a good percentage above 30% now of their income from the government. I don't want to get into politics. We're not going to go there. That's not what we're about. We don't ever go through and get into different political views. But in general terms, without talking parties, when the government is supporting the citizens, that's socialism. And so the fact that so many people are deriving a good part of their income from the government tells you that at some point that has to stop. It can't continue forever. So, I mean, that's a fascinating spike to the upside here. That was for you, Steve, if you're listening. And then here we have the U.S. budget deficit. Now, if you want to have a rough night of sleep, take a look at that. The Treasury federal deficit of surplus as a percentage of nominal GDP, minus 19. That basically means we can never pay off our debt, is pretty much what that means. But again, you can see look at the last time we had a surplus. Isn't that interesting? 1999. It's the last time we had a surplus. But we were doing good, and now it's off the charts to the downside. And then one more chart, and again, these are all from an interview that Jeffrey Gunlock had. Double Line is his company. This is the Fed's balance sheet. Now you can find this at stlouisfed.com as well. So if you go to the Federal Reserve's website, St. Louis Fed always publishes these. Look at that. So what does this mean? Obviously, they've expanded their balance sheet greatly. They're injecting tons of liquidity. That's what that means. So, okay, that's fine. They're putting a lot of liquidity into the market. Whatever. What do we care about that? That's been helping the stock market. It's been buoying it. Here's what you need to concern yourself with is they are going to get their money back. The Federal Reserve doesn't just give money away. They just don't say, okay, Treasury, go print money. We got you covered, and then never bring it back. At some point in time, after they've expanded their balance sheets, they contract their balance sheets, which means they're going to bring all of this liquidity back. So all of the excess liquidity that's been pumped into the market is going to be drawn back out. And what that means for interest rates is that they're going to go up. So rates are going to go up. And if inflation goes up and rates go up, now we're back in the 70s. And that was when Jimmy Carter was the president of the United States, who went down as one of the worst presidents we've ever had because it was a really bad economic time. We could be looking at that. That is not a far-fetched scenario to think of what are the repercussions of this. And if you listen to his interview, he talks about Chairman Powell's conversation that, oh, these inflationary things are transitory. That was the word. That's the buzzword that's been sent around on all the financial networks, that it's transitory. And he's like, well, you know, when we had the subprime crisis, and he actually showed a little clip of when Ben Bernanke said, oh, the subprime crisis is controlled. We have control of it. And then we know that wasn't the truth. We know what really happened with that. And so his point, or the question that he was putting out to people is, do you believe now their view that inflationary signs are transitory any more than you believe back when they said they had the subprime mess under control, when they didn't, and we had the great financial crisis afterwards? All I'm saying, and again, I try to highlight this as many times as I can, I am not a sayer of doom. That's not what I do. I know a lot of people make money doing that, and they create the most negative headlines they can in an effort to create a business model out of just being a fearmonger. We just try to look at the markets and share the best information that we have with our subscribers. And from everything that we've shared and what's been in those last several SPY updates, it's time to be cautious. If nothing else, you got to be cautious. Now, the other argument is, well, the Federal Reserve is still injecting liquidity, and as long as they're doing that, the market is likely to go higher. And that's a very good argument. If, and I highlight the word if, the Federal Reserve is doing what they say, because there's instances in history where they talk the markets. they try to jawbone the markets into thinking they're doing one thing, but then if you're really scrutinizing their balance sheet, they're doing something else. In other words, they're withdrawing liquidity without letting us know that they're doing that, and it's a slow process, and the market sniffs it out, and then when that happens, then the panic selling hits, and so it defeats the purpose of what they're trying to do, which is basically manage withdrawing all the liquidity back off of their balance sheets. See, when they expand their balance sheet, they do it at a cost. They don't give the green light to the Treasury for free. They charge interest. So when they're going through and they're injecting liquidity, they're making money off of that. That's a really important thing to understand, that the Federal Reserve does not inject liquidity into the market just for, okay, yeah, we need money. Let's just throw a few trillion in. No, they're making money off of that, and they're going to get their money back. And those are the facts. Now, the question becomes, how good is the economy going to be? Is it going to be good enough? And if we have 10% GDP, a roaring economy with tame inflation, we can probably survive the Federal Reserve withdrawing or contracting their balance sheet. But that's what it's going to take. It's going to take a significant amount of growth in the market with contained inflation. Otherwise, we're setting ourselves up for significant interest rate hikes, which the equity market hates that. It'll be good for the bond market, but the equity market hates it. And there's no way that we can continue to move to the upside in a significant fashion under those scenarios. So there's a lot of things to be concerned about. So if you've been watching these videos for a while and our track record of our case study considerations hasn't brought you into the fold yet, maybe you ought to consider it now, unless you're already on top of all those things that we shared with you, because I think we're getting ready to have one of the best times that we've ever had at Elliott Wave Options, and we've had some really good years. But again, our subscribers have never experienced a true down market. They've experienced a very short period, 1 month of a down market, and then we turn around and went right back up. But the amount of money that you can make when you have a significant downturn, I'm talking about 2000 to 2002, talking about 2007 to 2009, talking about those kind of periods where you have these big flushes to the downside, where you can make tons of money in very short periods of time. That's what we're looking at. All right, so let me go ahead. I want to share with you, and I'm going to pause the video for a second. I'll bring this up. And show you a case study that we closed a couple of them, so I'll pick one out to share with you. And I think we did a really good job of closing this out, especially based on what's happened the past couple of days on Friday. So that makes a lot of sense if you're going to close out a bullish trade. So the one that I want to share with you is something that highlights what we're going to be talking about coming up in our next series, our next educational series, which is going to be called Strangle Mastery. And I know if you've listened to anything, you're familiar with the strangles, etc. But what we're going to talk about in Strangle Mastery has to do with the Greeks and options pricing. And we get a lot of conversation with our subscribers because we will hold our case studies into the last month, into the expiration month. And people ask why? Because time decay is significant then. But the other Greeks work in your favor. Time decay is a negative, but a good part of the time decay is gone by then. So then you have gamma, which accelerates greatly. The further you get towards the at-the-money options in the last month, the higher the gamma goes, and gamma is how fast the delta goes, and delta tells you how fast your options are making money. So take a look at this. This was on ENBL. It's a great example of that. And you can see that we were in the trade for 71 days. For a good part of the trade, we were at a significant loss. In fact, we bottomed out right at April expiration. So then we move into the May month, which is what these options were, down 82%. So almost a complete loss. And if you're buying into one of those systems of close your position out when you hit a 50% loss, and there's a lot of them out there, look to make X number of gain, maybe 100% when you're right, but close it out at 50%, no matter what, close it out. Well, what you end up with is a whole bunch of 50% losses. And it's just like a slow bleed, death by 1,000 cuts on your account until you're done and you're out of the game. But we will hold them. And now we do have options that expire worthless. But if you have an option that expires worthless and then you go buy more time, it's actually less expensive to do it that way than it would have been if you stopped at a 50% loss, close the position out altogether, or if you rolled it at that point in time. Well, now you're re-upping for an entire new block of time value, and you just trashed gamma and delta and pushed them way back down at the bottom. Now you need a bigger movement to pull yourself out. So if you can get a decent price movement in the last month, that's where you're going to have better acceleration through delta and gamma. That's how it works. Now, there was a subscriber that wrote in that, well, there was news that drove the stock higher. It doesn't matter what the news is that drove it higher. What I'm talking about is the speed in which the options went from a 82% loss to a 27% gain. You can see the vertical movement of what happened there. And so we entered the trade back on February 24th. So this was the look on the entry. It was a wave 3. We had our target price, 7.5 strike call. So our target price there is just over 7.5, between 7.5 and 8. And then what ended up happening was the stock moved, and there we go. Blew right through the 8 target and closed right smack in the middle of the wave 5. And so, yeah, we didn't get as great of a gain as we would have, 27%. When you hit it spot on, you can look at it and say, well, that's not that significant of a gain. But when you were looking at almost a complete loss, and then within a few days, you're at a 27% gain, that's a massive turnaround. But the point is, and what I hope people gain from this, is it's an illustration of the math and how options work. And you have to understand the Greeks. You have to understand the Greeks. Just as I said, if you want to be a good equities trader, have a good working knowledge of the bond market. If you want to be a good options trader, you better have a good working knowledge of the Greeks. If you don't do those things, if you don't take your time to educate yourself on those things, then the successes that you have are luck, and you're not going to last very long, and you'll be blown out. People, have success. The Robinhood Reddit thing, they figured out that they're not nearly as smart as they thought they were. To come up with a system of, let's just find stocks that are heavily shorted and everybody buy them, and we're going to force the shorts out, and we're going to make a ton of money to the moon. Yeah, it worked for a very short period of time. You don't think there's smart people that would have figured that out a long time ago if it was that easy to force the shorts out? I mean, come on. It's silliness, really. Trading is not that easy. Trading is difficult, and you need to take the time and go through and gain your education. And if you put the time in and you gain the education, it can be an extremely rewarding career. You can add to your current income, or you can actually trade for a living, enhance your retirement, whatever your goals may be in trading. But it's not easy. You have to put the work in. So that's where the market is. That's the setup there. I shared with you the ENBL that was on one of our alerts for our alert subscribers, looking like it might be a complete loss, turned into a 27% gain, because the movement of the stock doesn't matter what caused the movement of the stock, because the movement of the stock was in the last 30 days, and it generated that acceleration of gamma and delta, and it turned into a profit. That's the reason. It doesn't matter what the underlying reason was on why the stock moved. All right, so now let's go through and take a look at some of our past case study considerations. We've closed a ton of them out if you've been watching these, but we still have some. So let's go through and look at them. So here was SWK, and this was back when we looked at it at 4.6. You can see it was a nice wave 3, and our target was 215. Now we've shared this with you on a couple of weeks of with that movement to the upside, how much do you want to make? But if we just go back a couple days, so if I just take these walk back keys and go back a couple days, right there, we've blown through 215. You could have closed it out the day before on the 6th of May, which would have been last Wednesday when we hit the target price spot on. So you've heard the things: bears make money, bulls make money, bears make money, and hogs get slaughtered. So at what point do you want to close the position out? So we're going to write that one off and say that one's done as far as generating gain. Century Casinos, we started that one on April 6th, but then we turned it into a strangle. And so here's what we were looking at with the strangle, because it had moved down and created a really nice looking triangle. So you're familiar with this. We've been looking at these over the past few weeks, but here's where we are now. You can see a nice blast to the upside, even in the face of today's market. We had a pretty nice day. Still finished down 2 cents on the day, but that's a pretty good looking bar considering what's going on with the market. So we've broken from the midpoint at 10.5 to 14. We're going to cross that one out too, because that's a pretty significant breakout move for a $10 stock. So if you're looking for more out of that, you might be asking a lot as well. So we're closing both of those. And then we have TWI is also one that we were looking at. So let's take a look at that. TWI. Titan hasn't done a whole lot since our entry, which was also back on the 6th. So let's walk it back to the 6th of April. So there's the 6th. We had a doji there at 10.19. And other than today, we're at 10.48. Yesterday's close was 11.29. So, I mean, it's moved up since our entry, but not significantly. So you can hold this one, or you can look to say, I'm not really too comfortable with the market right now. Maybe want to close that one out. We're going to leave it open from our case study consideration because it hasn't hit either a profit or a loss scenario. And our loss is, again, not a percentage of loss. It's a changing of the pattern to where the pattern would relabel and show that it was no longer a bullish trade. It's still labeled as a wave 3 to the upside. So from that standpoint, we'll keep it open. But if you're following along with it, it would probably be prudent to consider go ahead and closing that one out. SKM, here's where we looked at that one on the 13th. And it's just moved to the upside. Now, last week we talked about this as like, well, if you haven't taken your profits because it moved back down, maybe you got a little bit greedy. Well, now you're getting a second chance. That doesn't happen very often, especially when you have kind of one of these vertical moves. That's a little more than the 45-degree angle move that I like. So it's a touch more vertical. So it ran up there, it came down, but it's turned around, it's gone right back. So you're getting a second chance to take your profit at that level. So again, might be a good time to consider closing that one out. So we're gonna X that one off as a closed position from a profit target as well. Then we have SAP, and taking a look at that, we'll walk it back to the 13th. So there was the entry at 134.43, and right now We're back to 137. We did get a bit higher than that. We got all the way up to 143. So 143 from 134 is a decent move. You could look at that one and say, well, if you didn't get out, you might want to hold that. This is the issue here. Right there at 140 is a significant point of support resistance. It tried to break below it. And we got back above it. We held it until today. And then today we dropped back below it. So if you get a follow through day to the downside tomorrow, then you need to take that off. And you might be back to break even at this point if you do that. If you hadn't taken it off, now I can understand that that may not have hit a lot of people's profit targets as far as what they're looking to make on the money that they put at risk. That's a fair point. But still, if we get a second breakdown, because we could be looking at moving all the way down to this level here at 120 with some gaps. It's an ADR. So ADRs, if you've heard me talk about these, because they're American depository receipts, they're a vehicle to where foreign stocks can trade on the U.S. market. So they're subject to what happens overnight in foreign markets. So quite often you get gaps. You know, if it moves significantly overnight in a foreign market, then the corresponding asset gaps a lot in the U.S. market. So don't view gaps on ADRs quite the same way as I do normal listed stocks on our exchanges. But still, it's worth considering. And we do have tiny bit, not a lot of support right there. But if we break down again tomorrow, it's probably a smart thing to do to go ahead and take that one off. So looking at CREE, this was a really nice looking descending triangle that we had back on the 20th of April. And you can see we had one of those false breakouts to the upside, big movement to the downside. Nice recovery today. And that is key, isn't it? Because look what happened right here at that 90 level. And you don't think the longs were looking at this? We are not the only ones that look at charts. So the longs were looking at that and saw, man, if it breaks 90, holy cow, look at how vertical this move was. If we break 90, we may come down to 60 in a very short period of time. So the longs stepped in and supported it. We did get a reversal in the market, but the people that are long the stock clearly came in and supported that move. They don't want to see it break down below 90. That's a third, 30% loss in the equity itself if it can't hold here. So we'll continue to keep this one open and watch and see what happens. We opened below it, but we closed back above that level at 90. So you might want to make a note. 90 is a really, really key level on CREE. And then last week, we looked at designer brands, DBI, and pretty much where we were. So last week we were at 1878 and we were at 1843, so down just a little bit over the past couple of days. Was looking better on Friday. I don't know how confident I would be holding long positions, newly minted long positions right now with what happened in the last 2 days in the market. Again, we need to see tomorrow to see if the gap gets filled. If we get too oversold too quickly, then that sets up the position for a rally. What we're talking about as far as a down market is a sustained down market. That's not one that just drops like a rocket out of the blue. It's just where you're done at the top, the buyers are exhausted, and potentially an area where the Federal Reserve is slowly withdrawing liquidity. And so it's kind of a controlled downward move. But within that controlled downward move, there's big vacuum moves in individual stocks. That's where the profit's made. So we're going to want to see how the market handles this gap tomorrow to see if we come up and fill that gap. If we do, look at putting some downside positions or strangles, which is what we're going to look for tonight. Now, we also looked at LUV. We sent that out as an alert to our subscribers. So not only did we look at that as a TradeFinder case study consideration, we actually sent it out as an alert. And so here's where we are now. Not a significant move yet, certainly not a big breakout, just down about $1 or so from where we were. It is really going to be interesting to see what happens with the airlines. So if the economy gets better and it heats up and people are traveling, that's a good thing. I've highlighted this before, but with fuel prices going up and that spike in oil with the cyber attack, did you see that? There was a cyber attack that basically shut down one of the primary pipelines and oil spiked again. If you're not controlling your fuel costs, you're in trouble. Now, I know that Southwest used to do that. They used to be one of the airlines that does it. I don't have, and the reason I knew that was because I had a pilot friend. So let me reverse that. I had a friend that was a Southwest pilot who was on the committee that created their hedging program for hedging fuel costs. So at that point in time, I had direct knowledge of what they were doing. He's since retired, so I don't know if they still incorporate that program or not. If they do, then they're probably not in as bad a shape as some other airlines may be as far as trying to absorb these higher fuel costs. If they're not doing it anymore, then we'll know because we'll see a big downward movement. But regardless, on whether you look to see, okay, the airlines are going to explode because people are coming back, they're going to start adding capacity. It limits when you first come back, you get travelers coming back, so you get a little bit of a bump, but then they've cut so much capacity out. It takes time to add new planes, to add new routes, and start filling up again with people traveling to where that actually shows up on the bottom line. Remember, the market always looks ahead, but it takes time to get those things to the balance sheet. So you can make a case for any of the airlines, even Southwest moving either direction. Hence the reason you put on a strangle. You don't care which way it goes. Now, SIG we looked at last week, and boy, was that a good-looking triangle. Now, I looked at this one for our subscribers for an alert to actually send out an alert, but the options were no good. So that's a big part of trading as well. Just looking at the patterns is only one part. You have to be able to put on a good options trade in addition to looking at the chart pattern. So that, we had a big run up. We got a nice symmetrical triangle. One of my favorite patterns, honestly, as far as putting on the strangles, but the options were no good. You couldn't do it. Otherwise, we would have sent that one out. So here's where we sit with that now, basically right back where we were. Another false breakout to the upside, came back down. So we're right back to the point of the breakout. But I'm going to cross this one off because unless you're already in it, and if you did, you probably didn't get very good option prices. Hopefully you weren't following this one. But I'm going to cross this one off just because I don't think it's worth trading. The options were just not that good. So I don't know if any of you are following with that. If you are, make a comment. Support will let me know, and we can add it back in and follow it in future trade finders. But if nobody says that, hey, I'm following that one, will you please keep that one going? Other than that, we're not going to follow along with that. Now, one I wanted to share with you that was on our watch list. So we can actually do this one. I remember last week we had a few that we were looking at. So let's look at AMBA that was on our watch list. And if you go back, you can clearly see why I wanted to show you this, right? Because if we walk this back to last week, right there, we talked about how we were sitting right on this area of support, right there on support at 90. And if you look at the options, look at the moving averages, you can see we were a little bit oversold. But a break of 90, and all of a sudden that becomes really interesting as far as a move down to 60. Well, it held 90. We broke it yesterday, but no follow-through day today. So still not an entry yet, because even though it broke below 90 yesterday, we closed back to the upside today. We could actually get back above 90 and test that 10-day moving average again. I do think this one bears continuing to watch, though, just because it could be a significant move lower, all the way down here to pretty much 55 is where we could be looking at as far as a downward move in that one. But we need to see what happens over the next trading day or two. Could have been looking at adding that one today if we had a follow-through day, but we didn't. All right, so now let's go through and see if we can find some new case study considerations for today. Looking at this, if you're brand new, people ask about this a lot. This is a program called Profit Source that we use here. You can find more information about it at Profit Source, just exactly the way it sounds, .com. It's a Elliott Wave trading program. I'm a big Elliott Wave trader. I think I've traded all of the Elliott Wave, at least looked at all the Elliott Wave programs that exist. And this one, I think, is by far the best. When you look over here, you can see this area, Elliott Wave Options. That's for people that are subscribers to Elliott Wave Options as far as our alert service. So if you're an alert service subscriber and you have Profit Source, you get all of these additional searches. The hub people did that for us, in addition to what's common with the program itself, which is a really cool program because you can actually create your own trading system. Maybe you don't want to follow along with what we do. Maybe you want to create your own, or maybe you have your own and you want to program it in, and you can run tests and you can back test and you can look at historical data and go back and see, how your system would have done. You can program in, if you want to do percentage gains and losses, all that stuff you can do to test it. I mean, those are the things that I did when I was creating my system, but all of these things are available for you. And anyone that says EWO, basically those are my searches. That's what I'm looking at every single day. So for our subscribers that also have Profit Source, they're able to see exactly what I'm looking at every single day when I'm going through the charts. And often they will question and say, hey, I looked at this. You didn't send out an alert on it. I was curious as to why. Or this one you did send out an alert. Well, it's a good communication, educational tool to have this available. So we're pretty proud of that. So let's take a look at our impulse. And as you can see, there's only one. Well, that would make sense, wouldn't it? And look what it is. Holy cow. Check that out. There's only one on the list, and that's one we just crossed off tonight, SKM. Well, it says that it's not done yet. My own search is telling me that you're closing that one out too soon, that this could still go to the upside. Well, let's take a closer look at it. It's a pretty darn good looking DMI. See, the ADX is curling up, separation between the two directional indicators. We do have a move down in the positive directional indicator with an up day on the stock. That's not ideal. I still say that this one has moved so much that taking the profits, if you hadn't already, is probably warranted. Even if you take them on an upward move, that's fine. It shows up as a result, but I just think looking at the entire picture, we had a nice run out of that, and let's just be happy with that and let it go. But boy, isn't that interesting. The one result is actually SKM that we looked at in the past. All right, what I do want to do is look at consolidating stocks. That's where I want the focus to be tonight, because not really interested in putting anything on directionally yet. Let's put on Strangles to where we can profit on a movement either direction. So click on consolidating stocks, and that's my system that finds stocks that are going through consolidation. It doesn't guarantee you it's in a triangle. It tells you it's in a consolidation phase, which could be a sideways pattern. It could be a triangle. That's what we look for, is the triangles. So you have to just discard the ones that are in sideways patterns and look for those that are in triangles. Not as big a fan of pennant patterns or flags. I know people look at those for breakouts. I like the Elliott Wave corrective triangles are my favorites. So what we can do, because there's 102 of them, we don't have enough time to look at 102. Let's go back over here and look at bullish wave 3. And we can see Southwest. Check that out. Well, we already have something on Southwest. Caterpillar. We've had strangles on Caterpillar before. Boy, you can see why. It's done nothing. Trying to break out to the upside? Fascinating, isn't it? I mean, maybe. So maybe we're getting a false breakout to the downside too. We had a head fake to the upside. Maybe we're getting a false breakout to the downside as well. As I said, tomorrow means a lot. But looking here, we've had really just brutal sideways consolidation here. So if you've been long the stock, it's been pretty rough. Starting to break out. I don't really think that looks too enticing for a strangle. So let's look at something else. Darling. And this one looks better. It's still pretty sideways, but we take these things off and expand the chart a bit. We can see it's not quite as bad of a triangle as it initially looks. It's definitely not the largest though. And we've got a doji on today's bar. Let's look at the mouth. So 62 or 3 up to 80. Let's just call it 18 points on a $70 stock. So that's actually pretty good. It's a bigger triangle, as I said, than it initially appears when you're looking at it. And so that might be a pretty good one. Yeah, 70 is a really, I'm just examining the chart. 70 is a really good area of support resistance. You can clearly see how it was resistance back in January and February. We broke above it in March, tested it later March, tested it in April, tried to break below it, couldn't do it, tried it again in May, and we're just right there. So breaking to the upside, you go to 80 quick. And breaking to the downside, you have some support at 60 right in here. Not a lot, but some. And if you break below that, then you have a little bit of 55. So this will be a bit of a stair step to the downside, if you will, and then 50. So those aren't my favorite ones to the downside when you have areas where you go boom, bounce, boom, bounce, boom. We like the ones that have a vacuum to the downside better, but you have a 10-point move before the stair step starts, so that kind of gets you going. So this is kind of a difficult one. I'm going to make a note of it though. We'll look at 511 and DAR strangle. Doesn't look bad. Let's see if there's any with bearish wave threes. We haven't had a chance to look at those for a while, but with the movement in the market, we might see some. No. So that makes sense, doesn't it? Why does that make sense? Well, when we're looking at a consolidation pattern, we're looking at a low ADX. So if we're creating a bearish wave three, we've had a pretty significant move to the downside. You just don't get a lot of significant moves to the downside that then go into a really calm triangle formation and the ADX drops below 15. It just doesn't work that way. It was worth looking at because there were so many of them, though. 121 is it that are bearish wave threes? Hey, we take a look, take a shot at it, but there weren't any. So let's go back to just the consolidating stocks. I'll pick out a few. And then we'll take a few questions here to wrap things up for the night. But there you go. There's our Caterpillar and Darling already that were in the wave threes that we looked at. So what I do when I scroll down like this, in order to save time now, I look at every individual one during the day. I just click on the arrows. Let me show you what I mean. You can come up here and start and click on the first one, and then this arrow on the bottom right, just click on that and it advances it to the very next one on the list. So you don't have to keep going back to the list and looking. You can see, oh, there's a lot of them that are sideways. Remember, I said the consolidating stock search will find some sideways stocks as well. So you just funnel through those until you get the ones that have triangle patterns. ASHR. I stopped on this one because we've traded this before. That's a decent looking triangle there. $39 stock, 40, it's just not a big enough movement. That's too bad. The triangle pattern looked pretty good there. So you can just funnel through them all like that. Now, I don't want to do that. I want to go back to the search and look to see if we can find some that I am familiar with that we've traded before without spending the time to look at every individual one. You can see there's a lot of ETFs. There's 3 iShares in a row. And I'm just going to look for some that I've traded in the past. You got to look at this, right? GameStop is on there. Are you kidding me? How do you trade that in a strangle? You can't. You know, I know why, because I looked at it. It's impossible to make money on the way they have the options priced. That you look at that and you say, that's a great looking triangle. And we should definitely put a strangle on that. Don't do it. You can't make money off of it. The way they have the options priced, it would take a 200-point move out of the stock to make any money off of it. So just resist the temptation and move on. It's on the list, but you just can't make money off that. KB Home, that could be good. With uncertainty in the interest rates. Because once rates start going up, then we're going to have a downtick in the housing market. This one's interesting because this is an expanding triangle. It's not a contracting one, but it's still a triangle. We're at the midpoint of it. So 48 to 51 is 3 points. 48 to 45 is 3. That's really borderline as far as being enough movement. 6 points in the width of the mouth of the triangle. So what I'm doing is measuring the height of the low here. So that's 6 points. 10% is what's needed. So it does qualify there, but just barely. Let's see if we can find something better. Lear. And that was an ascending triangle. We're right at resistance at 195 and decent set of higher lows coming all the way down from 165. 165 to 195 is 30 points, so better than 10%. That stock moves. You can see that it rarely sits still. It did last year in the summertime. It had a sideways move, but other than that, it's quite often been moving directionally. And if you're wondering what am I doing going back, you want to look at the historical movement of the stock before you put a strangle on, not just the particulars or the technicals that you want for a current strangle. You want to make sure the stock is showing you that it has a propensity to move. Has this really moved in the past? And if it has, well then, okay, that's one we may consider taking a look at. And for the most part, Lear has. So I'm actually going to make a note of that one. I think that one's better than DAR. So I put that one down with a star because I think that could be an official case study consideration. We'll look at one or two more, and then I'll go to questions before we wrap things up. Electronics, we got to look at that. Podcast, are you watching? Sure you were going to ask about this one anyway, so check that out. All right, well, there we go. So this is definitely going to be an official one too. Look where that ADX is. Look at this triangle. So here's a stock we know can move. It's a volatile stock. The ADX has, man, it's so low. Look at that. It's down at 8. The reason I say that is I look at two different levels. If we have a lot of movement out of stocks and we can be picky, then I look at 13. I want to see them under the level of 13. But if we start to get to where there's tons of them and we really have to be picky, then we can start to look at maybe a little bit below 13. But it's rare that we start looking at under 10 and all the way down to 8 on the ADX. I mean, that's a stock that's really getting ready to move. And I know there's earnings, I think, in the not too distant future. So we'd have to double check what the options pricing looks like. But you're not going to find one too much better than this, I don't think, because we're at 40, 45 on the upside, 34 on the downside. So you're 20% movement versus 10. So that could warrant a little extra premium in the option pricing. If the earnings report isn't too soon, you could offset that. I'm not sure when it is, but I still think that one's worth it. So we're going to make a note of that. So there we go. And so PLT, Plantronics. Yeah, that looks good. All right, so we're at the top of the hour, but I'll go ahead and take a few questions if we have some. Zach, are you there?
Hi, Rob. I am good to be here. You have a number of questions. It just depends on if you want to take questions on the market or specific symbols and whatnot.
Let's do both. If you have a couple market questions, we'll take those, and then we'll do a few symbols and wrap it up from there. So let's try to do a mix.
Okay. Well, this first one we'll start out with Mike. So can you give some guidance on finding options with satisfactory liquidity, especially in markets like today with higher volatility and wider spreads? Thanks.
You know, Mike, I'm glad you said that because I mean, I talked a lot about the market longer than I anticipated. But one of the things that I did want to bring out is on a day like today, which was a crazy day. I mean, you literally couldn't leave your computer. We were, down 500, 600, then back to almost break even. The NASDAQ was down 2.5%, nearly 3%, got it all back, and then sold off again. It was amazing, the volatility today. In general terms, forgetting what was going on today, in general terms, when you're looking at options, for the liquidity, you'd like to have 100 contracts. The reason that we use 100 is because that gives you a chance to be trading with somebody other than the market maker. And we all know that what games the market makers have been playing with options pricing. If you've been trading options, surely you're aware of that. Over this past year, it's been interesting and equally frustrating what they've done. So when you trade less than 100 contracts, it doesn't mean you can't put that trade on, but just know you're likely trading with a market maker. You're not trading with somebody else on the other side of the trade. What does that mean? It means you're probably going to get a worse fill getting in, and you're going to get a really bad fill getting out. They're going to go, so if we buy at the ask and sell at the bid, and you're buying an option to get in, likely on the exit, if you're trading with the market maker, you're going to be selling at the bid. They're probably not going to give you the mid price. But if you have liquidity, if you have options that are trading 100 contracts or more, then you have a realistic chance of getting filled at the bid, unless you're in a really crazy day like today. So the point that I wanted to make, and thanks again, Mike, for asking the question to remind me of this, is days like today, you're better off doing nothing than getting caught in trying to chase a big, huge move to the downside, or, oh, we're rallying back, but then it turned around and went back down. It's a day to sit back, watch, learn, but it's not a good day to trade because volatilities were off the charts today, as far as, even though the VIX wasn't significantly, but options pricing, because the market makers had no idea what was going on either, and they're going to protect themselves. So thanks for that question.
Thanks, Rob. And this next one's going to be from Lindsay. What does DMI suggest about the market today?
Well, let's take a look. There was a crossover today between the, and this is something that's, we need to talk about for a second. So we had a pretty decent DMI going all the way back to, let me see if I can get the, all the way back to right there, right? So that was pretty close to our 420 peak. And then we had a little drift higher on the ADX, but the positive directional indicator was coming down. We hit this 420 level, and a signal, if you're using the DMI, a warning signal would have been not to go long on that, because although the ADX was moving up, it was above the positive directional indicator, which is telling you the strongest part of the move is over. So that would have been a warning signal, don't go long here. So then we come over here, and then we go Friday, where you're thinking, hey, we're breaking out. We're going to the 440, 460 level, 261.8% fib extension. But then you look at the DMI, and it's no, the ADX is now going down, and it's under the positive directional indicator. So no way do you want to go long. Now today we had a crossover. So today we get the crossover between the negative and positive directional indicator. We're showing you that sellers have slightly taken control. You've probably heard me mention this before, but it's worth reiterating, especially now. The sellers are very smart. Short traders are smart and they're savvy. Why are they smart? They have to be, because they take the most risk. Think about that for a second. A short seller takes more risk than anyone else in the market, and that includes options traders, because they have unlimited risk. So if you're going to be shorting, you got to be on your toes. You got to know what you're doing. So can you run short sellers out? Do short sellers get it wrong? Yes, they do. Everybody does. But in general terms, even though they're kind of viewed as the evil side of the market, short sellers are both necessary and quite often intelligent traders. My point here is that sometimes they test the waters. So they may not be ready to come jumping in with, a hard push to the downside in the market. They just kind of want to see how much resistance is there. If we press the gas pedal a little bit, do we get a response? Does the engine, give us a rev higher, or is it just kind of like a dud? So this may be one of those tests where they're just trying to see. Again, we need another day or two of trading in the market to have a better understanding. Our subscribers, alert subscribers, will have a better idea when we talk on Thursday night. We do webinars on Thursday night for our actual alert subscribers. That's for only them, and they can ask questions directly. So they'll have a better understanding. But to answer the question, what the DMI is showing right now is extreme caution. Sellers are taking control. The ADX is moving down. It'll take time for the ADX to move down from the fact that it was going up because of the positive directional indicator, for it to come down and turn back up if we indeed move into a downward move. But the fact that the shorts took over today means that you want to be really, really careful. So initiating new long positions needs to be, unless you're doing gold or something like that, you need to be very, very careful. And I would also share this. I wasn't going to show this, but since it came up, because we're going to see, what happened with the next S&P update if we fill this up. But we're getting pretty darn close to a pretty good looking expanding triangle in the SPY too. Okay, next.
All right, this next one will be from Pankaj. Said, can you please cover ARK? I have a 95 put on ARK, ARKK.
Okay, I was going to say which ARK. Okay, so ARKK. For those of you not familiar, the ARK funds are managed by Kathy Wood, and she made a name for herself because she's extremely aggressive, buying the high-tech stuff, the stuff that really moves, and she did really well, as you can see from this movement off the lows, not just from March, but from November as well. And so people were really looking. But when you trade that aggressively and then the market wobbles a bit, you get hurt. So Pankaj, I think you asked about this last week as well. And we were talking about 110 being important. You broke below that. Didn't get a follow through day today, but I think that probably has to do with the 10-day moving average more than anything else, because on the low at 100, you had some pretty good significant gap there. You have a little bit of support. Maybe it tries to hold here. I don't know that it would be successful. I think you're probably looking at the next point of support, stronger part being down here around 90. And so from 90, I think you'd be being a bit greedy if you held your short past 90. But I would qualify that by saying, let's see what happens in the market. Great call on the put. I think that was a smart move considering how aggressive she's been. And those are the first ones that get their hands slapped when the market goes through problems and correct. So that was a really good call. But you can see that it gets pretty cloudy past 90. So we touched 100. We're oversold on the day. Maybe we come back to 110. I don't know. I think we see 90 on the low, but then I would be cautious about being too aggressive lower than that, unless the market just falls apart. And it could. I mean, we could revisit that again next week and see.
Great call on the put. I see what you did there. That was a good one.
I was wondering if anybody was going to catch that little option pun there.
Yeah, we could stroll over that one. This next
See if everybody's still awake. It's been an hour already.
Yeah, I think you still got some people out there. Alicia would like to look at Fubo, given today's earning and big move.
Did they do earnings after hours? Or was it before?
I can check.
I mean, an 8% move today is a pretty decent move, but for this stock, it's really nothing. I knew the earnings were coming up on this one, but not sure if it was after hours or not. Let me take a look. Okay, so it was after hours, and it has made a nice move. So we're long this one too, so that's pretty good. Basically, the after hours move is going to bring it back above 20, that's good, but it's got a long way to go. So we're going to be, if we open where we're trading right now, somewhere in this area. But 25, I believe I've mentioned in the past, is the key. So we need to get back above 20. If we get back above 25, now we really have something going with Fubo. So we took a shot at that one from a really oversold condition, and it broke down a little bit lower. But we'll be back up with that earnings report today. So can it generate? So here's where the short covering comes in, right? So obviously you can see the stock was ridiculously priced, and then the shorts came in and they pounded it. And the last earnings report wasn't great, but it wasn't it wasn't good either. And so they pushed it, and 20 looked like a pretty good area of support, and then it broke down. Well, now we're back above that, so we should be looking good on our alert on it. But what we really want to see for a significant move is to get above 25. So breaking above 25 could be pretty nice, and it could happen. There's a lot of people that look at that level. A lot of the shorts, if it can try to trade at or above 25, are going to have to cover. They're going to have to cover their short positions, and that's when you get the big accelerated moves. I don't know if everybody's aware of this, but when you really learn about Elliott, a lot of the 5-wave patterns, that traditional 5-wave look of Elliott wave patterns, starts from short covering. The very first impulse comes from short covering. That's how the whole thing starts. So if you get enough of that, you usually get a little bit of a drawback. That's your second wave, and then you get the big move. So if we get that spike tomorrow, could be a wave 1, we retrace a little bit of that, then we might have something being off and running on a wave 3. So we'll see how it trades out, but thanks for bringing that up.
All right, thanks,
So
Rob.
10:15, so I'll take 1 or 2 more, and then we'll wrap things up for this week.
I think you've been generous. If you want to take 1 or 2 more, so we'll give you this last one from Brian. IWM has head and shoulders with gap at 197 and 165. How low is the realistic drop?
Let's talk about head and shoulders patterns. And we talked about this before on whether or not this was like a humpback, because it's not the cleanest head and shoulders pattern, is it? We have this pretty clear left shoulder, and then here's the top of the head. It's right here. And then it looked like we were forming the right shoulder. And then the question became, is that a failed head and shoulders pattern? We were on our way back up. And then we got up to here and we're right at where we were with the left shoulder. And now we've moved down. So it's not the most classic in the fact that this is messy right in here. So that's why I'm calling it kind of like a humpback head and shoulders. There's a hump in the shoulder there. But purists might not really like that one as a complete head and shoulders, but in general terms, it's pretty darn close. So to answer the question, when you have a head and shoulders pattern, you go from the neckline, which is right there at 220. You measure from the neckline to the top of the head. How far is that price-wise? So 220 to 235, it's 15 points. So then you take that same amount, 15 points, and you subtract that from the neckline. So 220 minus 15 brings you down to 205. So from a head and shoulders standpoint, your target price is 205. Now after that, you can look at Elliott wave, you can look at whatever's going on technically, whatever patterns available, etc. Look at your favorite technical indicators to give you an idea of whether you're oversold or can continue lower. But from a head and shoulders pattern, which is what the question was, 195 is the target. That's what we'd be looking at. So we'll see if that how that plays out. So there's a little bit of support there. So anything else?
There's a number.
205, excuse me. Not 195. Let me clear it. 205, not 199. 205. It's we're obviously getting long, so.
Absolutely. No, I thought that was a very interesting one to end on. So unless you want to take more, we'll save it for the end.
Well, I mean, we're at an hour and 15 minutes, and then we try to be respectful of everybody's time, yours as well. And so thanks, everybody, for watching. Again, I think we have a really exciting time coming up. If you want to be an alert subscriber, no better time than the present right now. We're going to see some pretty cool alerts coming through where you get big gains in very small periods of time. So come on and join us. Otherwise, thanks for your time. Have a wonderful week, and we'll see you again next week. Watch for the next SPY update as well. Thanks, everybody. Take care.